Are you struggling to prepare for your real estate exam because of vocabulary? Well, this is a session for you. We are reviewing vocabulary today that is crucial and you must know for the real estate exam, whether being national or Texas or any state. So this is vocabulary that applies to all states. So get ready. We're going to review as many as we can in about an hour and a half. Okay, so I'm doing something a little bit different than I have in the past. So I've created some slides here that I hope that you'll enjoy. So we're going to start out with some important vocabulary, and take notes, or you can watch the video afterwards. And I recommend that you watch it several times so that you learn the vocabulary. And if you can hear me, could you post a comment that you can hear me? So what is an appraisal? All right. So anyway, an appraisal is an estimate that an actual appraiser does on a home. And these are required by the lender anytime there is a loan. An appraisal, a professional estimate of a property's market value, typically required by lenders before approving a mortgage loan. Now, realtors, we do a comparable market analysis, which is a lot less detailed than an appraisal. So please do not get those confused. An appraiser is hired by the lender or is hired by a seller to do an appraisal, a current market value appraisal by within the last 3 to 6 months. And the markets that are changing quickly, they may do it within the last 3 months. And either the seller pays the appraiser or the buyer pays the appraiser when the lender is the one that's ordering it. Closing costs. What are closing costs? They can be quite high for buyers. So fees and expenses paid at the closing of a real estate transaction, including title insurance, attorney fees, and loan origination fees. So closing cost of the real estate transaction, there are also prepaid closing costs, which are like 1-year insurance or property taxes that the lender is going to want to escrow. And what is an escrow? It's like a little savings account that the lender will receive the money every time a buyer makes a payment on the mortgage. It's going to include an escrow amount for taxes and insurance. So at the closing, part of the closing cost, some of the fees and expenses that are paid is 1 year of insurance for the property, if it's a home, a residence, a condo, a townhome, and a few months of property taxes, so that there's enough money for the lender or the bank to pay for those when they come due. The title insurance, if the property is closed at a title insurance, then a title policy is required. And a title policy is what shows the buyer and the seller that it is free and clear to convey to the new owner. In other words, free and clear meaning it doesn't have any liens, any encumbrances, any other mechanics lien, judgments, probates, anything like that. So the attorney's fees can be for all the legal documents. Loan origination fees, those are for the lender. Not all lenders have loan origination fees. However, some of them do, and it can be a 0.5 point, 1 point, or 1.5 point. And what is a point? A point is 1% of the financed amount. So if it's 100,000, 1 point would be 1,000. All right. So that was closing costs. Equity. What is equity? Equity is the difference between what a person owes on their mortgage and what your home is currently worth. So that would mean what is the current value of the home in today's market compared to properties that have currently sold with the last 3 to 6 months. Typically, it's 6 months. When market is changing quite fast, then it's 3 months, where we want to do both. If certain neighborhoods, property might be turning around much quicker, so we'll do 3 to 6 months, but it's typically 6 months, and that's also what an appraiser will do. So that's the current value of the property. And the loan amount is the money that is owed. So the difference of the loan balance and the current market value is the equity. It's what they have gained. It's like a savings. They can actually get a loan on that equity. And so if the home is $300,000 and they have a $200,000 loan balance, then they have $100,000 in equity. They've already paid down the property value, or let's say they bought it several years ago and the market has appreciated. So now it went from 250 to 300,000. So they're making an extra 50,000 because of the market increase. So that becomes part of their equity, and they didn't necessarily have to pay that down. So that was equity. Thank you for joining, whoever is here. Oops. I'll make sure I don't go past where I'm supposed to. Okay, escrow. What is an escrow? Now, there's different types of escrows, all right? So an escrow is a neutral third party that holds funds and documents during a real estate transaction until all conditions are met. So that could be a title company. If the buyer is requesting title policy, then it goes to a title company because they issue title insurance. If it's not if they're not requesting title insurance or title policy, then it can go to a lender. So I'm sorry, not a lender, an attorney. So the attorney would be the escrow company, or the title company would be the escrow. Okay, so that's two different types of escrows. Typically, we know that is one type of escrow, either at the money that is being held in a trust account by the title company or an attorney. Now, this is during the real estate transaction until all conditions are met and it's closed. Now, if there's a loan, the lender is going to require their own escrow account. And that's a different little savings account that they, as the third party, are holding a little savings that includes insurance and home insurance and property taxes to pay when they are due. They don't want the buyer to make those payments on their own. Now, if there is 20% equity, like we did in a previous, if there's equity in the property, it has 20% equity, the buyer can decide not to pay, to pay the property insurance and the taxes on their own, and the lender will allow that because they figure they can end up getting their money if for some reason that buyer defaults, because there's at least 20% equity. Okay, so that was escrow. So two types of escrow: the title company or attorney, and that's during the closing. And then afterwards, it's the savings account that's called an escrow account that the lender has. MLS. Okay, so who is that Oscar that said hello? It says OR. You can type your name in and let me know who you are. That is really nice because I like to acknowledge you. Okay, MLS. What is MLS? Yes, Oscar. MLS is the multiple listing service. So once you become a realtor, you're going to join your local MLS, multiple listing service. And that's a database used by real estate professionals and also inspectors and appraisers to share information about properties for sale. So all properties that we are going to list, that means that we end up signing a contract with a seller to represent them and sell their property. They sell it, but we do all the marketing and to attract buyers and realtors. Okay, so that is the multiple listing service, abbreviated MLS. Pre-approval. This is something that's really important nowadays. Is required before we it's required whenever they're going to buy a property. A buyer's going to buy a property, right? And they're going to use a loan. We want to know, are they ready, willing, and able to buy? And how do we know that? By getting a pre-approval. And who do we get a pre-approval from? Or they, a lender, a bank, a mortgage broker. It's a lender's conditional commitment to loan you a specific amount based on your financial information and credit history. So any loan that a buyer is going to apply for is going to require their at least a couple years of income tax returns, their credit score, a financial statement from them, if they have, what kind of savings they have, what debts they have. They look into a lot of things. If it's going to be with a hard money lender, they'll require similar things because they're loaning money, but they can be a little bit more lenient. However, they will charge a higher interest rate. Okay, so that's a pre-approval. So when we take a buyer to show them homes, we want to make sure they're pre-approved before we show them our listings or another agent's listings, that properties that are for sale. Now, a lot of buyers will say, well, hey, you know what? I have an awesome credit score. I won't have any problems getting approved. Yeah, I've heard that before. All right. And they'll tell you, well, I want to see what I'm going to buy before I get pre-approved. And we're like, well, the seller wants to know that you're pre-approved before you go see their home. And so you're going to deal with a lot of different reactions from buyers. We want them to be pre-approved so that they're committed already with a lender and they can afford the homes that we are going to show them. I remember going and getting in the car right away and going to show homes. Well, that's not the way to do it. We need to get pre-approved. If a buyer doesn't want to get pre-approved, they're not ready, willing, and able to buy. Let them go to somebody else. Title insurance. I mentioned this during the escrow. So title insurance is only issued by a title company. It's insurance that protects the buyer and lender against any loss due to disputes over ownership of a property. So the title insurance, there's a title policy. The title company does research on the ownership of that property. It can be just from the current owner, or they can go through the history of the property, because sometimes there are encumbrances, attachments, things that are on that property that need to be cleared up before a property can be cleared by the title company for them to issue title insurance and be able to close the transaction. So it's learning the history about a property and the owner to make sure there aren't any liens. Well, they find out if there aren't any liens, any judgments, and the liens can be a loan, mechanical liens, judgment, spousal support, child support, all different types of debts that are recorded to the credit scores. Now, credit cards will also show up, but they don't show up on the title policies, okay? So, and then there could be people that got married or divorced, name changes. That puts a cloud on the title. That has to be corrected. So that is found out during the research of doing the title research. The title insurance is actually the policy, like auto insurance, homeowners insurance, and those are boat insurance, trailer insurance, medical insurance. right? They're a protection, a policy, and they're issued only by title companies. If the closing is going through a attorney, it's because the buyer is not requesting a title policy. They did their own research. Contingency. What is a contingency? It is a condition that must be met for a real estate contract to become binding, such as the satisfactory home inspection. So a buyer can request a certain number of days to do inspections on the home inspection. And then with the home inspection, the inspector might say, well, you need a roof inspection, or you need an AC, or plumbing, or electrical, or foundation. Those are the major ones, okay? There's the 5 major inspections that an inspector can recommend. So the buyer may say, well, my purchase is contingent on the house passing all those inspections. A lot of times it'll pass with just the home inspection. And then the negotiation goes back and forth between the seller and the buyer to clear up any repairs that may be done. Other contingencies could be that the buyer is selling their home and they want to sell their home and buy the home at the same time. So they'll ask the seller, well, are you willing to, can I put a contingency that I can purchase your home once I sell my home? And they can happen simultaneously. So in a market like now in Texas and many states, in a buyer's market, yes, a seller may consider that. However, it will have another contingency from the seller. They have a 72-hour right of refusal. In case they were to get another offer, their contingency is, okay, if you can't follow through purchasing the property within 72 hours, if we get another offer, then we will terminate your contract because your property hasn't sold. So it's a condition that has to be met in the real estate contract to become binding. And one of the main ones is a home inspection. Amortization. I just started seeing ARMs, which are, never mind, I better not get into that. Amortization, the process of paying off a loan through regular monthly payments that include both principal and interest. So typical loans are for 30 years. Those 30 years will be split right into monthly payments of principal and interest payments. And so that loan will be amortized for 12 months every year for 30 years. As the principal decreases, as the principal that they have paid increases, so their equity increases, the interest reduces. At the beginning, they're paying more interest than principal. As the years go by, then they pay less. More money goes into the principal than to the interest. So typical loans are 30 years. There are 15-year loans. There are 20-year loans. There are 5 years ARM loans. And those are typically the ARM loans. I started seeing them now. Okay, so they're amortized for 5 years, but they're typically interest only. Well, they can be interest and principal. However, at 5 years, they would have a balloon. So amortization, and the lender can provide an amortization schedule, and you can see it online. If you research amortization schedule, it's the whole schedule of the 30 years. Okay, what's the balance going to be every single month? How much is going towards principal? How much is going towards interest? And that changes every month. The loan amount doesn't change, but the principal and interest does. Now, the only time the loan amount would change, or the monthly payment, is because property taxes or homeowners insurance increase. The principal and interest stay the same. Okay, comparative market analysis. So this is kind of like an appraisal. However, it's a simpler form of comparable market analysis. It's a CMA. And what is that? It's a report that realtors do that shows the prices of recently sold homes, within 6 months that are similar to a property being bought or sold. So we compare the same features and benefits that homes have, all the specific, like number of bedrooms, bathrooms, square footage, number of garages, lot size, so that we can compare similar properties and determine, a value for the property that we're going to list for a seller. Or we do a comparable market analysis also for a buyer in order for them to decide what kind of offer to make. Now, there is also a competitive, so typical comparative market analysis only include solds, but a competitive market analysis will include actives, pendings, and solds. And that is what we use for sellers. And why is it competitive analysis? Because we want to show them how long did it take for a property to go pending to get an offer? How long has the active ones been on the market that are your competitors? Okay, other homes similar to you, that's your competition. So they want to know that. For a buyer, we just show them, okay, what has sold so that they can determine, okay, let's offer this kind of price. So again, a report that shows the prices of recently sold homes that are similar to a property being bought or sold. A deed. So if you own a home, you have a deed, a warranty deed, and there's different types of deeds. So a deed is a legal document that transfers ownership of real property from one party to another. So the deed is conveyed from a seller, the owner of a home, to the buyer. So the seller, the owner, what else do we call them? Seller, owner, grantor. Okay. So in a lot of documents, you'll see grantor and grantee, the OR and the EE. So the grantor is the one that's selling. The EE, the grantee, is the one that is receiving, that is buying, right? So OR is giver, EE is usually receiver. So that is a deed, and there's different types of deeds. Okay, earnest money, 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 money. So what is earnest money and who keeps it? So it's a deposit made by a buyer to show good faith in purchasing a property, typically held in escrow. There we go with the word escrow. We just reviewed that. If you didn't see it, rewatch the video so that you can see escrow. So it's a deposit that's held at the title company or by an attorney. It's held by the escrow company, by the title company, whoever is facilitating the transaction to the point of closing is who holds that deposit, that earnest money, and it goes into their trust account. FSBO. What is a FSBO? A for sale by owner. A property being sold directly by the owner without a real estate agent. A lot of homeowners have been able to sell their properties, and I have too. However, I've always been a realtor. However, I can sell it without paying a commission to my broker when they allow us to do 2 or 3 properties a year as far as an investment. And I still have to disclose that I'm a realtor, right? Because I am licensed, but FSBO, for sell by owner. There is also a for sale for rent by owner, FRBO. You may also see that. That's for rent by owner. So those are investors, somebody that is renting the property. Okay, so if it's the majority of for sale by owners, 85 to 90%, even higher, will eventually list with a realtor. They get more marketing, more exposure, and typically a better amount of money. HOA, HOA, no, HOA, Homeowners Associations, an organization that manages and maintains areas in a residential community. Typically, these residential communities are gated nowadays, but not necessarily. And some homeowner associations, they charge a lot because they have amenities. They can have swimming pool, a children park, basketball courts, tennis courts, a community center, and an event center, or others are golf. So depending on what amenities they have, then their association may charge higher. A lot of times they cover the water and the sewer and the trash. Other times they don't. The owner has to do that. But the owners have to abide by the restrictions that a homeowners association has. So the restrictions were created by the developer or the builder of that subdivision or of that area. And those restrictions are usually tighter than the regular zoning restrictions. And a lot of times, most of these, they won't allow like broken down cars that need repairs, trailers, boats, any other things like that, or trash or things. You have to follow rules. And a monthly HOA fee can be paid, or quarterly, or half a year, but it has its benefits. A lot of people do not like homeowners associations because it really increases their monthly payment. What is a lien? A legal claim against a property that must be paid when the property is sold. So a lien, is it only a bank loan? No. It can be a mechanic's lien that was put on there by an employee of a contractor or a subcontractor that didn't get paid, and they put the lien on the builder's property, or they did work on a homeowner and the homeowner didn't pay them, skipped out. And so the contractor or subcontractor or plumber or electrical, those are all subcontractors. They can put a lien on the property. There is a statute of limitation. They have a certain number of days, and they have to disclose that to the owner, that if they don't get paid, they can attach a mechanic's lien to the property. So they may not get their whole amount, but you see, it says a legal claim against the property that must be paid. This is one thing that is a must when the property is sold. So they'll get some money. So it can also be legal claims, and other ones are bank loans. So there's priority. There could be liens like property taxes. There could be, so you may have property taxes, superior lien, a sub lien, subordinate lien. Research and find out that there are many types of liens. PMI, property mortgage interest, right? I was going to say PMS. No, it's not PMS. Property mortgage interest, insurance, I'm sorry. So insurance required when a buyer puts down less than 20% on a conventional loan. So, and that's on a conventional loan. If it is FHA, then it is MIP, mortgage insurance premium. That's different, and that stays on until the mortgage is paid. But on a private conventional loan, if they put only 5%, right now there are 5% mortgages, then the lender is going to require that private mortgage insurance in case they default so that they can get their money back. Once they have 20% equity, let's say the market increased or they made larger payments, and now the difference between the market value of their home and the loan amount is 20% or more, they can request the lender remove the PMI. Is the lender going to volunteer and say, hey, we can reduce your PMI, we can eliminate your PMI if you'd like? No, they're not going to let you know. I mean, they should, but we have to ask for removing them once we have 20% equity. That's the cutoff point. So that was PMI. Principal. Is that the principal of a school? No, that's spelled different, right? This is principal, the amount of money borrowed in a mortgage loan, not including interest. Okay, so the principal is just the loan amount. The interest rate, right now they're in the upper 5s and low 6s, mid 6s, depending on a credit score for VA loans, FHA loans, Federal Housing Administration, or even conventional loans, but it'll depend on the credit score. Now, so the principal, okay, is only the amount that gets applied towards the loan, which increases a person's equity. That is how much they own that belongs to them. The interest usually takes most of the monthly payment and a little bit goes to principal. As the years go by in the amortization schedule, you can see that more goes towards the principal and less towards the interest as the years progress. Realtor, that's what you're going to be once you pass your real estate license. That's what I am, right? A realtor. We're not realtors. We're not relators. So many people, and I used to use the word realtor. There's no A between the L and the T. It's realtor. So a realtor is a real estate professional who is a member of the National Association of Realtors. So you might say, so what's the difference from a realtor and an agent? Well, a real estate agent doesn't have to be a member of the National Association of Realtors. However, they will not be considered a real estate professional, and they don't get all the benefits and recognition as a realtor does. So they may be working for a brokerage as a transaction coordinator or showing homes or something like that, and they don't have all the designations of National Association of Realtors. So when you finally pass your exams, you want to be a realtor. You sign up to National Association of Realtors, your state association of realtors, and then for your local MLS. Lots of costs when you first get started. So again, realtor, not realtor. Short sale. Oh, these are starting to happen now. Okay. Because a lot of people, they owe more than the value of their home. They bought when the market was high and got high mortgages, like in 2020 and 2021, where there were multiple offers and people were offering hundreds of thousands, 20, 30, 50, 100,000 over the list price. Because why? The interest rates was really low, high 2s, low 3s. So excellent time to buy. But when you pay a whole bunch more, then real estate eventually, it cycles. Okay. It goes up and goes down. So it cycles up and down and, kind of escalates, goes up. However, the value of their home, of the loan, doesn't change unless they pay a lot of money down on it. So it's a sale where the proceeds are less than the balance owed on the mortgage, requiring a lender approval. And a short sale can only happen if there's a single loan. The lender will only approve a short sale as a single loan. So in 2007, when the market crashed, I was in Oregon and I became a short sale expert. My engineering background and detail oriented helped me to help a lot of people that were losing their homes and the market decreased tremendously. And so when does the short sale type of situation happen? Well, it happens when people move into an area and they start paying more than what the list price is on a home because they really want it. So when I was in Oregon, we were getting a lot of Californians coming to Oregon paying over and above, okay, the value of a property. So the market in Oregon was increasing 20 to 30% a year. That is not realistic. Eventually it crashed. And a lot of those people that bought those homes during those years ended up losing them. And so I helped a lot of people negotiate with the lender. I would put them on the market and then negotiate with the lender to take less than what the individual owed on their mortgage. There were the Mortgage Debt Relief Act with the government put out in 2007, where those buyers, if they were in a hardship situation, I mean, the owners were in a hardship situation and they had to do a short sale, the balance difference of what they sold it for and their loan amount would be forgiven. Of course, it does ruin their credit, okay? But at least they don't have to pay those thousands of dollars on the difference of a home. You know, can you imagine continuing to pay for a home that you sold on a mortgage and you no longer have it? Yes, it's really hard. So it was a market crash that happened throughout the US and more in certain states. It wasn't as bad in Texas. So we are experiencing at this age that type of thing because of all the properties. Let me go back. Because of all the properties that were purchased way over the list price back in 2021, 2022, and in 2023, the prices started going down and becoming more realistic. Well, we're in a buyer's market then. Back then it was a seller's market. So now those individuals can't afford their homes anymore. You know, cost of living has increased. Yeah, a lot of economical changes going on. Underwriting. Are you writing underneath something? No. Underwriting is the process by which a lender evaluates the risk of a lending money to a buyer. So they need to evaluate. So the initial approval, pre-approval of a loan is done by the immediate lender that we interact with. Then they collect all the documentation, all the financial credit score and tax returns, and then they send it to the underwriter and they see if that buyer, okay, can really qualify for that loan and if the home is worth what they're buying it for. So all the process of buying a home, the value of the home, the credibility of the buyer, all gets evaluated by the underwriters of the lending institution. Zoning. What is zoning? It is strict. It determines how the city is organized, arranged. Local laws that require how property can be used in specific areas, residential, commercial, industrial. So, and like churches can be built anywhere, residential, commercial areas. However, with residential, then we come into, okay, is it a dense population or is it out in the country, in the rural area? So in the urban areas, there will be different types of zoning, like R1, R2, R4. So R1 is one property per lot. R2 can be a duplex, okay, per one lot, but it's an area that's a little bit more dense. has a little bit more population. And then the next is R4. So it's different in different states. Okay, so I'm sharing with you what I'm dealing with in Texas and in our communities, our counties. So you would end up looking at what those are in your state or in your county. And that's how they measure where they can have a higher population, the infrastructure of the city, plumbing, irrigation, expressways, can it withstand a larger density of people? And so as it goes out into the county, then you have, dealing with acreage, you can have manufactured homes, but residential. So those local laws regulate how property can be used in specific areas, especially within the city. The zoning is stricter in the city than it is in the county. And the county is where you have rural land. And for commercial, of course, it's during commercial properties. Okay. And there's different type of commercial also. So you'll learn a little bit more about that later. Abstract of title. What is an abstract of title? Like abstract pictures? No. So abstract of title is a summary of the legal history of a property, including ownership, transfers, and liens. So this is what the title company does when they're researching, the title of the property. They deliver what we call a title commitment, and that's the abstract of title, which has all the research that they've done. And they'd say, okay, we can commit to, after doing the research on this property, the legal history of that property, with ownerships, transfers, marriages, divorces, and all kinds of liens. So that is called an abstract of title that is done by the title company. Attorneys do not do. If an attorney is going to close a transaction, that they become the escrow officer, they order a title policy from a title company. If the buyer that is going with an attorney and the seller, because there are sellers and buyers that want to use an attorney and still want a title policy. If that's the case, the attorney will order the abstract of title, the title policy, through a title company. Attorneys do not do those. Adjustable rate mortgages. Okay, these were just introduced. They're called an ARM, adjustable rate mortgage. Learn the acronyms also. A mortgage with an interest rate that can change periodically based on market conditions. Okay, so ARMs, adjustable rate mortgages, they could be for 1 year, 3 years. They're usually odd numbers, 1, 3, 5, 7, 9, and then there are 10. And the interest rate could stay fixed for that 1, 3, 5, 7, 9, or 10 years. After that period, that rate can adjust. More than likely it will adjust. Now, does it mean that it's going to adjust up, or could it go down? It could also go down. I had an adjustable rate mortgage on an investment property, a multiplex that I bought in Oregon. And luckily for me, the interest rate went down from 9.5 to 5.5. And that's when the market crashed. I had bought it just before the market crashed, and therefore, interest rates went down. And so it was great because I only had an interest only. So some of these ARMs can be principal and interest, others can be interest only, which means the principal never reduces, where the borrower is only paying interest. And that's what I was doing. I ended up selling it in 10 years. And but it was a little cash cow. So adjustable rate mortgages, ARMs. Okay, here it doesn't tell you how many years. However, you could get a question in the exam that says, oh, this property has a three-year ARM. What does that mean? It means the interest rate is fixed for 3 years and will adjust once the 3 years are done. That borrower is either required to refinance that property, or they'll hold on to it and risk the interest rate changing, adjusting. A balloon payment, so that can happen after an arm, okay? So a balloon, right? The balance, the time for the payment to be due, poof, pops, and the whole payment is due all at once. So a large final payment due at the end of a loan term to pay off the remaining balance. And that can be an ARM, an adjustable rate mortgage, or someone got a regular 15-year loan. Okay. But if it's amortized, then it's going to end up paying off in 15 years. Now, if someone is providing owner financing, let's say an investor, an owner of a home is providing owner financing to a borrower, and they say, well, I will provide you a 30-year fixed loan, amortized 30 years with a fixed interest rate. However, I want you to pay it off in 5 years or in 10 years. So that has a balloon payment at the end of that 5 or 10 years. Some investors will do that. I used to do that for 10 years, or it can be renegotiated. And others will continue it kind of like a bank, right? That's why people become investor, or some individuals become investors, because we can make money through selling property on owner finance or loaning money. We better know what we're doing. So it's a large final payment, okay? The balloon payment, a large final payment due at the end of a loan term, okay? Loan term to pay off the remaining balance. A bridge loan. Oh, you're going from one side of the bridge to the other. So think about it when you're taking the exam and you come up with something. I imagine, okay, on the other one, a balloon, right? The balloon eventually will burst, right? So a bridge, you have something between a start and an end point, right? So it's a short-term loan used to finance a new home purchase before selling the current home. So they have a new home at the end of the bridge, and they have an old home, okay, at the other end. So a lender can provide this bridge loan in the process, a short-term loan to finance that new home before that seller sells their current home. And that is called a bridge loan, helping them move from their home to a new one instead of requiring right away to sell the current home before you buy another home. However, they might be buying a home that needs to be built. And so a lot of times that's when it's provided. A bridge loan will be provided a lot of times when there is a new construction. Finance a new home that's under construction. A cap rate. When is a cap rate used? And what is a cap rate? So it's capitalization rate. That's what a cap rate is. A measure of return on investment for rental properties. So it's used with commercial properties or rental properties. People want to know, okay, what's going to be my rate of return if I rent it for this amount of money and I have these particular expenses? So how much should I pay for that home? So they look at, how the cap rate helps them decide, how much to pay for a home that they're going to buy, and because they want to have a rate of return, right? They want money on their investment. They want a rate of return on their investment. Therefore, the capital rate is used on rental properties. And there's a formula for capitalization rate, but we're not going into that here. Closing disclosure. So the closing disclosure are for properties that are sold with a loan. So it is a document that provides final details about the mortgage loan received 3 days before closing. So it doesn't tell you here who's getting that document, closing disclosure, 3 days before closing. Well, the buyer. So the buyer is getting a mortgage loan. Therefore, the buyer now has to receive that closing disclosure, which before it used to be called a HUD or a settlement statement. We still call them settlement statements, but now the correct term is closing disclosure. So they're disclosing all the costs that it's going to take to purchase that property. All the mortgage costs, all the title costs, inspections, insurance, taxes, recording, any repairs, anything that was done, all of that will be detailed. So they'll have the debit and credit in a column, kind of an accounting. And if it's a cash, it's called a HUD, okay? And it's a settlement statement. But when there is a loan, then the buyer, the title company, and the lender have to have that. So the lender will prepare their side of it, provide it to the title company or the escrow officer, and they create the closing disclosure, which includes all the expenses and all the paids, all the debits and credits, so that they know exactly what they have to come into closing with or what they're going to get back, if there is any. So it is provided to the buyer, not to the seller. The seller will get it once the buyer, if the buyer is uncomfortable with something in that closing disclosure, they can decide not to close. So it gives them time to review it carefully and decide whether to proceed to closing or not. So it's called a CD, closing disclosure. Covenants. What are covenants? Rules and restrictions that govern how property in a subdivision can be used. Rules and restrictions that govern how property in a subdivision can be used. So earlier we were talking about zoning, and I said some of those areas or, deed, there could be restrictions. And I said there is the developer, okay, can request certain types of restrictions on that subdivision. Okay, when we were talking about HOA, homeowner association, I said some subdivisions that are gated. So a covenant will say the person that developed that subdivision added stricter rules than the zoning has. So they have to meet all the zoning restrictions, and then they add others. For example, we want 3-bedroom, 2-bath homes that are 2-story with brick siding, 2-car garage, driveway, and sidewalk, curb and gutter. And they all have to meet those restrictions. You can't come and build a wood house. You can't bring a manufactured home. You can't build a stucco home. It would have to be brick, and it has to meet all those requirements. It could be more than 3 bedrooms and 2 baths, but it can't be less. So those are stricter rules that a subdivision can have. And then they have a homeowner association that administers or makes sure that everybody follows the rules. Depreciation. This is great if you've got investments. So what is depreciation? The decrease in property value over time due to wear, tear, or market condition. So depreciation becomes a tax shelter. So as an investor, if we have investment properties for rentals, then they depreciate every year because of wear and tear and market conditions. Now, the property value could increase. That's different. but this is depreciation over time due to wear and tear or market conditions. And there are other things that come into it, homes being outdated, or there's 3 different types of conditions of a home, whether it can be repaired or not. I think one of them is physical, functional, and I forget the third one. Okay. Or let's say brand new homes have come into the area, and now this little house that the investor bought, well, now they have the ugly little house and a beautiful subdivision, and they can upgrade it. However, the property has depreciated. So an accountant will depreciate an investment for 27 and a half years. And so every year they'll depreciate at 1/27 and a half. And so many investors will sell their properties after 27 and a half years. In some instances, it could be more than years, because now they don't have any write-off as far as interest, okay, or depreciation of the wear and tear on the property. So they'll sell those properties and go buy additional ones. So depreciation, the value of the home depreciate because of market condition and due to wear and tear. But on the other hand, it could appreciate in value because the market has increased in the area, or the neighborhood homes have appreciated and have bigger homes. That has a positive impact on the little old ugly house. All of a sudden, like in California, oh, those little bitty houses are worth $1 million, where here they would be worth 3 or 4 million. Here, meaning in Texas. Okay, easement. There's different types of easements. So an easement, a right of use of another person's property for a specific purpose, like utilities or access. Now, utilities easements, those are right of way for the electric company, the phone company, the water company, the sewer companies. So those we cannot change. Okay, those are by the local zoning and are required. Now, other types of easement could be a driveway easement, where one property shares their driveway with the adjoining property, or it could be a well, it could be a septic. Okay, those are easements where there would be a dominant party and a servant party. The dominant party would be the one that has access to use the driveway. The servant party would be the one that owns the driveway. But utilities and other access, like alleys or such, for, fire trucks, emergencies, and all the utility equipment to come through. So let's say an individual has a lot, and behind their lot are all the utilities, the power poles, the phone poles, if they still have landlines, or the sewer. So a person owns that land. However, they cannot build on it, because it is a public easement that has a right of way for the utilities. And if somebody does build a fence over it, whenever the utilities have to come by, they'll have to take it down. Now, they'll probably want to work something out with the owners if it's a fancy fence, but the owner will end up having an issue by building something on a utility easement. Fair market value, FMV. Know those acronyms, okay? The price of a property would sell for between a willing buyer and a seller in an open market. So the fair market value compared to a comparative market analysis, fair market value is what a seller and a buyer are willing to agree on. The sellers will, even though maybe the comparable market analysis or the appraisal came up higher, but if the seller says, hey, this is the price I want, and the buyer agrees, that's the current fair market value for that home. What they decide on the price of that property and it sells for, no matter what the appraisal is or what the comparable market analysis is. That is the price between a willing buyer, ready, willing, and able buyer, and a seller in the open market. And so, when we have properties out in real estate, that's the open market. Foreclosure. Hopefully you'll never have to deal with a foreclosure. However, if you do, hey, you won't be the only one, and it happens to a lot. It even happens to the wealthy, the rich. What is a foreclosure? It is the legal process by which a lender takes possession of a property due to loan default. So the borrower here could have done a short sale if they had one loan. However, if they had more than one loan, the lender is not going to allow a short sale. Therefore, if the borrower cannot come clean or cannot, catch up to date or reinstate that loan, then the lender will take possession, but they have to follow the foreclosure laws of their particular state. So in Texas, we have a non-judicial foreclosure process, meaning that the lender doesn't have to go to a judge to get a judgment in order to start the foreclosure. In the state of Texas, we have a deed of trust with a warranty that is provided with the loan. There's a deed of trust that gives all the instructions on what process to take should a borrower default or a lender have issues. In other states, it's a judicial foreclosure. There's about 50% of states that are non-judicial and judicial. If it's a judicial, it can take longer and they have to go to court to get a judgment in order to start the foreclosure process. So in your state, make sure you learn what the foreclosure process is, because we're at a time where foreclosures are happening, and Texas is one of the states that's having the most foreclosures and short sales. Okay, so I said we were doing 32 today according to my my title. So that was the 32nd for term vocabulary, and we'll continue 30 on another Wednesday. So any questions on all of this vocabulary? I used to do a lot of vocabulary. Every session I would do vocabulary, national, and then state, but I would do 2 hours. Okay. And sometimes I might do that because vocabulary is extremely important. And that's why my sessions are a little bit different. When I go through questions and answers, I pick out the vocabulary and point them out to you so that you understand, and you see, oh, there's the vocabulary. That's how it used. Oh, that'll help me. Okay. So these are more vocabularies that I see, and I should prepare and study these. So I recommend that you study at least 5 vocabulary a day, in addition to questions. Okay, and learn that. Make it a schedule where you study every day, because there are hundreds of vocabulary, probably over 500 vocabulary in real estate. Any questions? All right, thank you. Thank you for the claps, Oscar. Appreciate it. Yes. So we will continue with vocabulary either next week, or I may combine vocabulary and questions next week, or I may add another day to do a live stream. If no further questions, no input, we will call it a day. So this is Wow Lily Hendy coming to you from San Antonio, Texas, with YouTube Agent Prep, here to help you prepare to pass your real estate exam, whether it be a national exam or a particular state exam. For me, I am in Texas, so I review Texas state questions in addition to national real estate questions. I'm also doing other types of videos that are for once you're in real estate. What can you do? Like I'm reviewing going after expired listings, and I will add more. I just started doing that. So I'm not just doing preparing for passing your exam, I'm doing afterwards. And for other realtors that could use my knowledge and my expertise and my experience, I'd love to help them out. So if no further questions, until next Wednesday, catch you then. Thank you for attending. Oh, and make sure you watch. I have so many videos. Okay. I've been doing this since 2020. So there's lots of national videos. There's a lot of Texas videos. There's a lot of vocabulary videos that I have created over the years. So look at the playlist. I have some by years. National questions are basically going to be the same throughout the years. What changes are the state. Some of the state questions do change. So if you're studying an old exam, it's okay, but to make sure that you also study current prep books, like the prep book that I recommend that's in the description. You know, you can buy that prep book so that you follow along when I'm doing the questions and the answers. Vocabulary, you can Google and get some, okay, anywhere. Some books will include vocabulary. A lot of them don't include it now. So you get the vocabulary separately. All right. If no further questions, catch you next time. Love you all. And I wish you the best and pass that exam. You say, I pass, and I pass. And you will. And if you don't pass the first time, hey, you have 2 more chances. And now you rearrange your schedule and organize yourself to study the material better that you didn't know the first time around. Wish you the best. Bye.